Good afternoon, everybody. Can everyone hear me okay? Awesome. Thanks, guys. Thank you all for coming here today. Again, it's a pleasure to have you and host you guys here at the lovely Lambton Golf Course. You're all here for the Left to Learn M&A Transactions in troubled times fireside chat with some of our panelists here that I'll introduce later on today. I'm your moderator, Peter Stefanovich. I'm the president of Left Associates. We're a supply chain, transportation, logistics, mergers and acquisition investment bank. We're based here in Toronto. We work in the United States and Canada. We work in trucking, logistics, supply chain, 3PL, warehousing, brokerage, anything that touches the supply chain, we're investment bankers on. And we've got tons of depth of experience. We've been about 250 years of combined experience between all our staff here, and a lot of our staff you guys have probably met today. And love to enjoy the conversations we're going to have here today. So thank you guys for coming here today. Appreciate that. The purpose of today's event is to really discuss what's going on in the current economic environment and how it relates to everyone's businesses really here today. That's in the supply chain. That's, again, logistics, trucking, transportation, warehousing, and ultimately how it relates to mergers and acquisitions, which is kind of an end goal for a lot of people. And that's really the purpose of today's conversation, is to walk you through what has happened, where we are where we came from in the past, where we are today, and what the future is going to look like. And I think you guys are going to have a really informed discussion today with really all our panelists and hopefully myself here too. After the introductions, I'm going to go into a little bit of a lay of the land from an economic trend standpoint that we're seeing again in the supply chain industry, and how it relates to obviously M&A. And from there, we're going to go into the fireside chat where we discuss with a lot of our panelists here to discuss the current industry and how it relates to their space. And we get some good questions after from hopefully everyone here, and as well as people online too that we're live streaming as well too. So again, appreciate everybody coming here today. So we'll start off with the introductions. We're going to start off with Stewart Metcalfe.
Thanks, Pete. Stewart Metcalfe. I'm an executive vice president at Colliers International. We're a global commercial real estate firm. I've been there 25 years. I help clients with all their supply chain real estate needs, be it leasing, be it selling, be it investment sales, land acquisitions, dispositions, and advisory work with them.
Arun Rebello, National Manager for Transportation and Logistics at TD Bank. Been in the role about 5 years, been with the bank for about 20. Focus on financing solutions across the country. Don't manage a portfolio, act as consultant for the bank, but work for the bank in everything transportation, road, rail, air, marine.
Great, thank you.
Mike Zelma, I'm at BDO Canada. I'm on the Valuations and Modelling team. We obviously have all of our other typical accounting services at the firm. Been there for over 2 years now, but was at Canada Pension Plan Investment Board for about 5 before that. We help our clients with M&A related valuations, tax valuations, financial reporting, purchase price allocations, or just kind of pricing analyses, just to give kind of an informational view on the value of their business as well.
Great. Thank you, guys. Appreciate everyone for coming. Before we jump into the fireside chat, I just want to give an economic landscape of what we're all probably seeing right now. I'm sure most of you guys are seeing yourselves. I'd say one word to describe the industry the last year, and that's in transportation, logistics, supply chain, is volatile. I'm sure all of you guys are seeing that right now. There's a lot of volatility in the market space, and that's not just from our industry, that's across the macroeconomic landscape, and even covers into geopolitical landscape too, with wars going on overseas and a lot of anxiety happening in different places of the world. But especially, we are considered, transportation and then logistics is considered the bellwether of the economy, and we're seeing that volatility really hitting the market space currently. So I think that's a word that really describes 2023 when we're talking about the space that everyone's in here today. There's been a lot of changes in the marketplace. So really since, 2023, but before we jump into where we are today and where we're looking at in the future, it's important to look back a little bit and get a good understanding of where we all came from. And I'm going to get everyone's mind to go back to March 2020, when really the world stopped. I think everyone remembered the NBA games and the hockey games, that they just called those games. And that's when a lot of people were COVID-19 started, and everything, businesses, manufacturing facilities, your shippers that most people work with, shut down. And we shut down without any certainty. So talk about volatility 2023. I think if you go back to 2020, that was extreme volatile. no one knew what was going to happen. There was a lot of uncertainty going on. And the weeks that followed, manufacturing facilities were shut down, lines of production for automobiles, everything else were shut down. It wasn't really until May 2020 where things started to progress and come out of the shutdown mode that we're in. And it was a slow progression coming out of it. But I think most of us in this room here today saw, huge uptick in spending that came from the consumer, and a huge interest from the consumer on buying different things. And for everyone here today, what that meant was more things had to be manufactured. More people were at home doing work. And ultimately, there was a lot of free capital that the government and everyone was spending in order to get people back into the economy and spend more money in the economy. There was in Canada, the CERB payments, CEBA, United States, the PPP loans, forgiveness, full forgiveness loans as well. So a lot of money was injected into the economy at that time. And what we saw there was a huge inflated space in the economic sector where people had expendable income that they didn't used to have. And again, for everybody here today, that meant a huge uptick in the market, right? And what we saw again, record container prices at $15,000 US from the composite index perspective. Labor markets were extremely tight. Finding drivers, finding warehouse pickers, finding dispatchers, salespeople. Even today, there's still some setback of that in the current environment, but that was peak when trying to find people to work and paying exorbitant prices for people to start working too as well. At that time, from May 2020 to June 2022, there was a 237% increase in the space that we're in transportation. That means there was about 350,000 new entrances in North America. That's in logistics companies, that's in warehousing, that's in trucking. That's people starting with one truck and getting on the road to move freight because they saw huge economic upside to being in that space. So there was 350,000 new entrants, which is massive. So think about it from a supply and demand perspective. All these people are coming in because there's huge demand. There wasn't enough supply, so everyone was jumping in. So that's vital and important. I'll reference that later on. As we get to those points, you start to see that's big upside that happened right at the early parts of, call it COVID 2021, early 2022. But then March 2022 happened. And that's when everything started to come down from a level of understanding that we were in a bubble. That was the interest rate hikes. They started in March 2020. That went up from 25 basis points on the first increase in the US, where the benchmark is right now 5.33, to, in the Canadian side of things, March 2020, went from 50 basis points to 75, and now we're at 5%. And with high interest rates, money's more expensive to borrow, right? Borrowing for leasing, for real estate, we're going to get into that later on. Borrowing from M&A perspectives, it became obviously a lot more expensive to do business. And obviously for the shippers too, everything up and down the supply chain became more expensive. So that's something to note. With the high interest rates came, obviously those borrowing costs, where we talk about the $15,000, the composite index for containers, now they're down to $1,500. That's a massive drop, right? So we're seeing these drops happening at the end of, this cycle that we're in. We're still coming off some of those COVID highs, as I mentioned. There's a significant amount of inventory that's still coming off the marketplace from the overbuying that shippers made during the peak of COVID bubble that we had. So that looks to be coming out of the market in the early, call it this holiday season and into the early part of 2024. So we're still trying to get through the excess inventory that hit the market. So that's important to note. And it's, there's a lot of industries that were impacted with obviously compressed rates, that everyone's seeing compressed rates, compressed volumes in today's environment, where, people are seeing 10, 15, 20, 50% decreases from volume and rates themselves too, especially in the spot market. So if people are jumping on the spot market, well, a lot of the new entrants came in this environment went on, they're seeing the biggest decline in the work that they were focused on. So the money that they were able to make driving a truck. So that's been a huge decline. So on top of a little bit of negativity there, we saw recent collapses of Yellow Freight and Convoy, right? So Yellow from an asset-based carrier standpoint, and Convoy obviously from a digital freight brokerage. And there's some nuances with that I'll get into a little bit there, but Yellow should have been, put out to pasture probably years ago. So it was some of the economy, but also some of the businesses practices they performed were tough. In Convoy was another big impact that people saw recently. Again, Jeff Bezos put a significant amount of money in that, and it was supposed to be kind of the spearhead of the digital freight brokerage world. And something to note about the digital freight brokerage world, that was a volatile space to be in, and it worked from a model of high capital going in from a venture cap perspective with cheap money. And when that dried up, obviously with high interest rates, then things like that came crashing down. So that's the bad news. So I'll get into some of the good news that's going on. So the Federal Reserve and the Bank of Canada have come out strong, saying that interest rates are going to be holding. They don't necessarily say that out loud, but just from what we've seen, with a lot of the inflation rates have come down. Just to give you an idea, June 2022, the inflation rate in the United States was 9.1%. It's pretty massive. In Canada, in June 2022, was 8.1%. Today, inflation is 3.1%. Canada. The US is 3.24%. So it's come down significantly. So those are good indicators of the economy looking at a better position for most of everybody here, as well as the macroeconomic outlook as well too. So inflation's coming down. Ultimately, what leads to next is potentially interest rates coming down. I think the Bank of Canada and the Federal Reserve have all said that the idea will be a slow decrease in interest rates, which will help most of everyone here. I think the economy in general, sort of call it preventing any recessionary trends that a lot of people have seen in the past and that what people were worried about. So that's important to know. Trailer orders are up from September to October, the first 2 months of consecutive trailer order increases. That's dry van. There's been 2 months of fleet purchases of the specialized transportation market that have also increased over the last 2 months, and they're sold out from an allocation perspective for very specialized equipment for 2024. So that's a good sign. We've got tonnage, truck tonnage, it ticked up 1.1% from the annual low in April 2023. So that's another good indicator of what's going on the economy. So volumes are ticking up. Again, that's across North America. Also, you look at load data. So this is another interesting piece. Load data from Texas and Mexico have increased. They're up 9.1%. And I think there's a little bit of outliers in that because there's been a lot of nearshoring that's happened after COVID. So a lot of people have brought things over, which is actually good for the transportation supply chain industry. So there's going to be more manufacturing happening in North America. So that's another increase that's going to be quite interesting to look out for. And also the inventory I was talking about earlier. We're seeing signs that the inventory from retailers are getting rid of that old inventory. So the majority of retailers have come out saying that the inventory is going to be out by this holiday season and a little bit into Q1 of next year. So that's a good positive sign. They're also seeing, other indicators that are happening too. We've seen a huge demand come down from earlier, and that's a lot of the entrants that have come into the market are shedding. So the majority of those new entrants have been leaving. So the ones that are new people that have come to the space, the majority of them have left the space, and there's still some more to happen. But the people that have been here for longer than the past, call it 3 years, are in a good position because you've got a steady, sturdy business that have good, long-lasting customers that people respect. And as soon as those other entrants leave the market space, it's going to open up a good void for people to come in, get more opportunities, have more volume, and new growth into sectors they didn't think of. So some good economic outlooks on that. What does this mean to the M&A environment? So that's really, from our perspective at Left Lane, what we're looking at too. Again, there's volatility from really the enterprise value of 2023 for a lot of our clients. And getting deals done have been a little bit difficult in really Q2, Q3 of 2023. But we're seeing an uptick in the market. So a lot of people are looking at the positive nature that we're seeing that I just mentioned through, that people are interested in finding solutions to either exit or buy businesses. Now, the caveat there, a lot of the venture cap and some of the private equity people that don't own a platform transportation or logistics business are not looking. But that's okay. There's literally millions of transportation businesses from a strategic acquirer that are out there. And they're all looking for great opportunities to expand their businesses on the next upcycle of transportation, which is probably going to be in the next 2 years or so. So there's a lot of buyers out there, less on the VC and less on the private equity, unless there's a portfolio company associated with it, but it's still a lot of opportunities. A lot of people made tremendous amount of capital in the early part, obviously 2021, 2022. So they're sitting on a good war chest that they're able to act quickly when they need to. Now, some caveats in there from an M&A perspective to think about. Buyers are obviously a lot more cautious, and we'll get into some of the banks on their cautionary focus on, funding transactions and other things too, real estate included. And, there's a lot more due diligence that have to go in. So the due diligence that was done about 2 years ago or 3 years ago is different than today. There's a lot more scrutiny going on from the banking perspective, from, other outside lenders' perspective, and really from a buyer's perspective. So that ends up being a little bit more difficult. But, if you work with a correct advisor that knows the space well, they'll walk you through that. But it's obviously a lot more details that go into that today. Something to also note that if you've been in the specialized space, so the non-typical general freight, very commoditized freight, there's a lot to be said about that specialization from an M&A perspective, that those multiples are holding. So they're not decreasing. There might be some nominal decreases by 25 basis points, maybe 50, but it's very nominal. So if you're in a specialized space, be happy you pick that space, because if you're in a very commoditized general space, there's going to be some volatility in those valuations that are coming out, because stuff has come down in the commoditized space. But again, specialized, it's holding strong. So from our outlook, from a M&A transportation perspective, they've been holding well for, companies that we're selling, as well as when we're buying companies, the same thing holds true. So it's actually been quite, positive to look at there. Again, if you're in that niche space, if you're not in it yet, you might start to look at that, because that's where we're going to find a tremendous amount of value. We sell quite a few companies that are in those niche spaces, and they're commanding, good multiples at current rates. So that's actually quite good. On top of sort of the buyer scrutiny that they're looking at from an M&A perspective, there's going to be strategic buyers that obviously are looking for obviously value purchases, but you don't want to find those guys. You want to work with people that know the space and want to find the correct buyer. Everybody always comments to us about TFI and Mullen and some of the larger guys that are out there. There's literally hundreds of thousands of transportation companies out there. So the default doesn't always need to be talking to one of those two players. If you find the right party that knows all the players that are out there, you want to talk to them, or hopefully like us, that know a lot of the parties that are out there. So it's not just going to the few that are out there. It's finding the ones that are, that will be the best fit for your company culture, your economic outlook for yourself personally when you want to exit, but a lot of other things too in mind. Also, something to note is the buyers are showing a lot of preferences for, businesses that are, again, not just specialized, but have normalized earnings. So meaning there's a lot of volatility that I mentioned earlier. So buyers are not so much looking at the historicals from the last, call it 2021, 2022. They're looking at 2023 and pro forma in the future. What is it going to look like over the next 4, 6, 8 months? Because ultimately, everyone knows that here, there was a huge spike. And is that going to be recreated anytime soon? Probably not. So what buyers are looking for, what's the normalized enterprise value of their business? And that's something that people are really scrutinizing now. So it's something to keep note of that as well too. But as we look forward to the future, and we're going to get to the panelists here in a sec, is what we're saying in the market that 2024, by the end of kind of mid to end of Q2, there's a lot of positivity when we're looking at, interest rates potentially coming down, even 25 basis points. That's going to be a lot of positive nature for the rest of the economic outlook. And as well as a lot of buyers have to spend money, from some of the growth aspects they're looking at doing. So we see a lot of uptick in that space. So from an M&A perspective, kind of Q2, Q3, Q4, 2024 looks actually quite positive from our end. And hopefully, as you guys see the market, and hopefully things you get to see, again, volatility still a little bit, but as you get into Q2, it's going to actually be quite, positive from our outlook and the data that we're seeing ourselves. So on that note, I'd love to bring in our panelists and really get some questions answered that I'd love to have everyone listen to. And really the first one is, how has each of your sectors changed in 2023, and how has it impacted your customers? So maybe we're going to start actually with Michael on that first.
Yeah, sure. So I think maybe I'll talk from a more broader valuations perspective first. But in general, the risk-free rates have just gone up like crazy. 2 years ago, we would do any valuation. The start of our weighted average cost of capital build up would be 1.5%, 2%. Now it's high fours, sometimes up to 5. So all else equal, you have a normal beta of 1, and then market risk premium of 6. You're already at a 10, 11% discount rate at a cost of equity, without talking about size or company specific risks or anything. So all else equal, valuations have dipped a little bit. And in addition, Peter mentioned the wage inflation too in the past couple of years, and that's hurt a lot of businesses as well, hurt their margins. So it's been a lower 2023 from a valuation front overall. We're also seeing a little bit more of an increase in kind of goodwill impairment work as well at the firms, just to kind of fully test, given everything is showing signs of impairment from an accounting perspective, not a real perspective, but from an accounting perspective. But overall, yeah, I think 2023 into the first quarter or two of 2024 will be a little bit more uncertain still, maybe some volatility, but we're definitely hoping and looking towards interest rates dropping a little bit towards the end of 2024. So looking out for that for sure.
Arun.
No surprise here. I mean, we've definitely seen freight volume come down. We've seen, freight prices come down, which obviously has a direct impact on both margins and resulting cash flow. I mean, even on our existing portfolio of clients and even potential clients, in my role, I'm across the country, and it's the same story across Canada and even the US. One aspect is everyone's like, oh my God, what's going to happen? But really, we're starting to see some turnaround. And the questions I always ask is, what are you doing differently? I mean, we've seen companies that were relying on one income stream, whether it was dry freight or reefer, start to diversify a little bit more. As a little bit of a, bone of contention with a lot of people, it used to be, specialization was key. When I say specialization, I'm not talking about just, what kind of freight, but what income stream did you rely on? Seeing more of a transition going from asset-based, companies are looking at diversification into logistics, into freight brokerage, kind of, where's that income stream coming in? Because bottom line is, as this turns around, and it will, I mean, it's not the end of the world. As it turns around, is it 6 months? Is it 12? Is it 18? I think I was talking to a couple of individuals out here. If I knew that, I'd be buying the lottery ticket, but I don't. But realistically, there is a turnaround coming. It's what are you doing differently to weather the storm today?
Great. Thanks, Arun. And Stewart.
I've never thought I'd say this, but I miss COVID from your introduction. I'm a commercial real estate broker, so industrial asset class particularly. So we obviously, as Pete said at the beginning, we really enjoyed that period because everything went from retail into warehouses. But to look at 2022, 2023, we have to look back to sort of March 2022. What's happened to our industry? How's it impacted it? Public markets move faster than the private markets in terms of valuations and the likes. But we definitely saw, a pullback in values. The tune of 5 to 10% on vacant assets. Investment assets pulled back more than that. Interest rates really big impact on them. The key thing we've seen, we've had a declining vacancy rate forever and ever and ever, where the power's all been on the vendor or the landlord side of things. So we're finally seeing a shift in the balance of power on our side, which is a big thing. Our availability rate went from 0.8, which was a historic low. We're now sitting at 1.8 and, pushing towards 2. So it's, I think it's been, beneficial for the occupiers out in the market. I think we're seeing a cresting in terms of values, where building values and real estate values went down pretty quickly. Lease rates continue to rise right from March 2022 until about the end of summer. And we're finally seeing some cresting going on that. So I think there's a window of opportunity. I think we'll see the new construction deliveries have increased. The absorption levels have declined, not in a dramatic way, but enough to shift that balance of power. So I think there's opportunities going to 2024 for operators that want to take advantage of them.
Great points. Now, and just to follow up on Stewart's point, there's, obviously looking at situations from, where things are today, but there's a lot of opportunities ahead too. So if anybody has any thoughts on, being creative with potential opportunities, like any one of us on the panel are here to help discuss that too afterwards. So there's just take a bad situation and turn it positive, and definitely a number of manners here today. So appreciate that. On interest rates. So I know we touched on, I brought up interest rates quite a bit, and that's probably going to where a lot of the conversations are going to go today. How are the rise in interest rates impacted M&A over the past year? And maybe we'll start with Mike and go down the chain again here?
Yeah, sure. So I think, as I alluded to earlier, enterprise values have fallen a little bit, multiples have fallen. However, saving grace is that if you're a strong business and you have quality characteristics, you're going to weather the storm better. You're going to have a higher resilience. That said, if you're asset based, you're going to take a hit if you have debt. Obviously, from an interest rate perspective, the debt service is going to be rough. But at the same time, if you're asset based, you can raise debt easier in all else equal than an asset light. For an asset light, I guess the same thing is if you have that good business, it's great. But if you operate in a more of a commoditized market, as Pete was mentioning, the margins are going to be squeezed. It's going to be a little bit more of a worse situation for you. And then obviously we've seen the disruptors, the convoys of the world come in and fail as well. So all else equal, enterprise values are down, but the key point here is, good business is a good valuation, right? Hundreds of thousands of them are entering the market. How many of them are going to be strong quality and, last 10 years from now, right? So the better the business, the better the valuation for sure.
Right. Thank you, Arun.
I like what Mike had to say on, with the elevated interest rates. Yes, it's had an effect both on, margin compression, but also more importantly on the multiples. What we've started to see from a financing standpoint is really the effect on deal structures, going from an all cash transaction to just an all cash, cash and VTB. But what we're also seeing more importantly is earnouts, transactions are being tied more closely to earnouts because, 21, 22, how reflective is that of today and definitely tomorrow? So those interest rates have definitely had an effect. And mainly what I'm seeing is on structure, cash flow for sure. But earnouts, I think, and Pete, you probably see this a lot more, is earnouts are having a bigger play for sure.
Absolutely. And just a couple on that point before I leave to Stewart to answer is earnouts have been, a part of the M&A space for a while during, the peak 2021, 2022. They pulled back and it was, again, a lot more, significant, more cash on close. But in today's environment, obviously that's come down because of that, again, that conservative nature that a buyer is looking at. They want to be more cautious. So there's less cash on close than there would have been, call it a year ago today. So that's definitely something that's impacted.
Yeah, from industrial real estate perspective, it's extremely interest rate sensitive. So it's impacted us in a number of different ways. I look at three different buckets, but the owner occupier out there looking to acquire a building, I'd say they're probably benefiting from 5 to 10% pullback in terms of values. We're very dependent on what the bank will do for us. Every transaction we do, going into those heady days that we loved in COVID and that time, we could move through transactions more fluid, 20, 30 days conditions. We're now taking longer to go through the due diligence, get the bank on board. But we're seeing values probably on the owner occupied side fall back 5, 10%. The biggest impact has been the income in place properties, the investment properties. They've had the biggest pullback. They're directly following the interest rates where the cap rates are following them up. So that's been a big one for us. And then finally, I'd look at land, the bucket of land. Land is probably a big factor. I'd say the land market, because of the interest rate rise, the cap rates have been going up, the uncertainty. A lot of the merchant developers, which are the lifeblood of speculative development for us, they've been quieter in their land acquisitions. So, leading with an opportunity with the merchant developer sort of softer in the acquisitions of land, I think there's an opportunity in it. We haven't seen values really come off, but the transaction volumes come off significantly. So opportunity, I think land will show itself in time because the transaction volume has gone off. Somebody that does want to get out, eventually they're going to have to, move on that.
Great. Now, great points. Thank you, everybody. Switching a little bit of gears to looking at the thought process on good advice. So what do you think what can all the panelists up here give advice to a seller looking at exiting the market from each of your respective fields? Again, we'll start with Mike.
Yeah, I'd say start early on the preparation for the sale. I think the easiest thing from our team's perspective and our M&A's perspective, our M&A team's perspective, is if you have clean financials, good financial governance, right? You have a history of maybe not reviewed or audited statements if that's not in the cards for your company specifically, but something that's very reliable that quality of earnings can come in and not change much. kind of thing, or not point out much. Starting early is important because, you know, you can't just kind of cosmetically change your business a quarter before kicking off a process to sell. Like, people are going to poke holes in that. And I think another thing that's really important is getting a tax advisor on early if you're looking to sell your business, because I'm sure everybody would want access to the lifetime's capital gains exemption. And if I recall correctly, and get a tax advisor for this, you need to be a Canadian resident for a couple of years when you own it, I think. But more importantly, your assets, the majority of them, need to be actively involved in a business in Canada, earning business income. If you have cash just invested in the side, GSEs, those types of things, those are not earning business income, and it could mess with your ratios and you might not qualify. That's the last thing you want when you sell your business and realize you can't take advantage of that huge deduction. So I would say start early, prepare early, ask an advisor early, you know, what you can do to get started now.
Good points.
I'll probably start off by saying 3 words: plan, plan, plan. I cannot tell you the number of situations where we've had where, you know, individual comes in and goes, I'm selling my company. When? I think I'm going to close in about 30 days. Yeah, that's a little bit of a challenge. You know, start the process early. But more importantly, when you're looking at buyers, you've built this company from probably nothing. Look at your staff, whoever's buying. I mean, sure, you get the luxury of leaving, you know, maybe you've got an earnout, you go off, retire, that's great. But look at your company. What's the price you're getting for it? Is it the right price? Why are you selling? Are you selling because you don't have a choice? Is it succession planning? Is it retirement? Look at the company this is your legacy. So start early, you know, to your point, you know, sure, you're looking at the numbers and all, but look at the synergies. You know, you're going to be around, probably if there's an earnout, you want to make sure it's in the right hands. So start, you know, it's almost like if a buyer is interviewing the seller, do it the other way. Interview your buyers. Why do you want to buy my company, right? This is your legacy. So ask those questions, start the process early, get professional advice, get your advisors, get your legal counsel, your tax planners on side early. That's going to be key.
Right.
Our side's a little different on the real estate side. We're not, you know, focused on the financials or the contracts or the key employees or the customer concentration. We're that afterthought. And real estate, we've often been told by people, it's not on fire and I'm not getting kicked out of it. It's number 21 on my list of 20 things. But it's not when it comes to the final strokes of the M&A deal. You know, if they're leased assets, make sure you have proper transfer rights, that there's going to be no hiccup in terms of landlords approving a transfer or any hooks that comes with those transfers. You know, options are new and continuity of the operations within the facility. You know, any indemnities that might be carried there, both financial and other indemnities that carry through for you. So there are a lot of things on the lease side, but on the ownership side, we see it time and time again where real estate's 21 on that list of 20 priorities, and they come weeks before. Have they done an environmental audit of the building? Have they done a building inspection? Is there asbestos in it? Are there title issues, standing work orders? So many of these things that real estate really falls off the side. So do jump into it. There are lots of great consultants. It could be a broker. It could be a building inspector, an environmental firm. But that's taking longer and longer to do. There's a lot of bureaucracy around it. So, you know, get that done at the outset because it's straightforward and simple, but definitely, you know, push it up the list, the real estate side.
Point out of that. Make sure your zoning's in place.
We talked about that a lot at lunch. There's, you know,
Or it exists in general.
zoning are things that come in place where a business might be operating in a facility and there's a change in zoning, but it was grandfathered, but it's not grandfathered in the transfer of the asset. So there are nuances there. So it's a very good point.
Yeah, it's vital points you don't want to find out during the M&A process. You want to figure this out well in advance. So good points, plan. Maybe flip it a little bit. And what would you share that buyers should be looking for from the M&A perspective you guys see in your fields? So maybe start with Mike again. And
yeah, so you know, the first thing, I think Arun mentioned this, but the first thing we talk to our clients about when they purchase a business and we do a valuation for it or a purchase price allocation or whatever is, well, why did you buy the business to begin with? There's obviously many reasons, but you don't want to just have them stumble on that answer. So is it synergistic benefits that you mentioned? Are you getting into a new geography? Are you buying technology maybe? Or are you buying talent? You know, when drivers were at a shortage, are you buying talent? You know, there's many types of whys, but having a good why is and a strategic rationale for the acquisition is good. How are you going to execute on the transaction too? Do you have an internal team that has, you know, all the necessary skill sets to go from, you know, first conversation to post-close integration and everything in between? If you don't, it's obviously very beneficial to hire an advisor who does this day in and day out. Tax considerations, how are you going to structure the deal? Assets, are you going to buy the assets? Or are you going to buy the shares? And how are you going to structure the actual purchase price? Is it all cash? Like was mentioned earlier, is there an earnout gonna be included, holdback, working capital adjustments, you know, debt adjustments, all of those types of things. And then, as I mentioned, how are you going to integrate that business into your fold, especially if it's cross-border, right? If it's a different culture, how are you going to integrate that? So a lot of things to consider, but you know, that's what we would look for sure.
Great, thanks, Mike.
I think you touched on most of the points I was going to talk about anyway, but what I'll add on is, in addition to, you know, your financial due diligence, do some operational due diligence. You know, get to know the culture. These are going to be your employees. You know, sure, why are you buying the business, but how do they fit into your company culture? You know, is there going to be retention of staff or attrition? You know, cultures, I mean, over the years of businesses that we finance, you see that. You see the attrition because the culture doesn't work. You know, who's going to stay around? They've got a lot of the client relationships. They've got relationships with the entire team. So, you know, get to know that company before you pull the trigger. Financials, absolutely. That's table stakes, but I think operational culture is key.
Good point.
Yeah, from a real estate side, I'd to really understand the market. You know, where does the target acquisition company fit in the market? Where is the strategic opportunity in terms of, does it have strategic land parcel that might give you a transportation advantage? Does it have leases in place or owned assets in place? But know where the market's going, the trends, where are lease rates going, where are absorption trends going, where is there a flood of new spec development coming on? And how does that give you a competitive advantage or walk you into a red ocean where there's, you know, you're going to be fodder there. So I think it's really understand the market thoroughly, the trend of where it's going and how your assets fit into it. We get called in a lot by private equity firms, family office when they're doing acquisitions, and the first thing wants to do is do a mark to market of, you know, where their lease rates are on the acquisition lease and where they are today, and where's the arbitrage in that. You know, if they have a lease rolling out 2-3 years out, you know, where's it going to reset? How does that affect the EBITDA? And we see that a lot. Where you've got 2-3 years of, you know, very advantageous lease rates, and then they're going to reset it, you know, 2x or 2.5x of that. And how does that figure out? And that's, you know, that's Pete's world to figure that out. But it is going to change your EBITDA, and it's the 2 to 2 and 2.5 times sometimes with at least been set in place, you know, 7-8 years ago. So it's a big factor. Look at the market, look at the trends of where it's going.
And to build on some of those points there for Stewart, it's a follow-up question is, sitting here with everybody here, if anybody's looking at it from a buy or sell side, is it better to lease or is it better to buy a property? And let's say if all things are equal, like what are your recommendations?
I mean, that's the age-old question. It depends. And I won't say it depends. It depends what your goals are. I mean, the last 20 years, anybody who's owned real estate, it's been a phenomenal coup for them. You know, I remember valuing real estate that, you know, is 10x now what it was 20 years ago. So it's been a phenomenal win for them. Whereas, you know, global firms we work with that have leased their real estate, you know, they're coming off 10-year leases and then now facing their leases to go triple. So those that owned had a big lift and built an incredible amount of equity. Those that leased are seeing their cost base triple. Going forward, I don't see that same thing. The last several years, we've had 20 to 30% annual increases in the lease rates. So, you know, it's, you know, if you had long-term legacy lease, great. But if they're rolling over, it's a challenge. But on the own versus lease, you know, there are the risks and benefits. Our private equity clients, the first thing they want to do, they get a higher return. It's really their hurdle rate. You know, is your hurdle rate higher in your business or the yield on the real estate? Private equity, the first thing they want to do is sell leasebacks and get it off balance sheet because they're getting a much better levered return. Family operation, it could be a great pension fund. It could be a great way to build up equity. There's depreciation. I won't get into tax, but, you know, depreciation benefits on it. So it really depends who you are. You know, family-run businesses, a lot of them like to own it, particularly if they have a lot of improvements in them. If it's just a straight-up warehouse where you can get up and move to another one, you don't necessarily have to own it. But if they have any improvements in it, conveyors or processing equipment or anything else in there, ownership can be beneficial. But if you're private equity, you know, it's really, you know, you're getting higher yields in your core business, and you're probably going to be a one owning or leasing it.
Great. No, great points. I appreciate that. Question made for Arun now is focusing again sort of on the M&A side, especially from financing M&A transactions. What are typical deal breakers you see in transactions that you're reviewing from your standpoint of the bank?
So from a deal breaker standpoint is, you know, does the acquirer actually understand the business they want to acquire? You know, what sort of due diligence have they done? You know, what's the rationale for buying this business? We're asking the same questions that we ask the same questions to the buyer that we expect the buyer to ask the seller. You know, are there synergies? You know, or are you buying it just because you think it's a good deal? Well, why do you think it's a good deal? What's the sustainability prospects of the cash flow? Because at the end of the day, that's what we're lending money on, right? We're lending money on that cash flow. So have you done the same sort of diligence that we're looking at? Is there any equity going into this deal? You know, whether it's rolled over equity, whether there's an earnout, is there a VTB? Sometimes it's great, but a lot of times, sometimes you see, you know, you're looking at a full cash transaction. I said, okay, if you're looking at a full cash transaction, what's your fallback? Do you have access to equity should you need it? And sometimes there isn't. And then, you know, as a lender, you're looking, prime example. I mean, if we financed a company in 2020, 2021, next 2 years, fabulous. Today, it's a little bit of a different story, you know, and it ends up being a tough conversation. And I'll say this, I've been doing this for 20 years. Nobody wants to have that tough conversation, right? I mean, this is your bread and butter. So we're asking more of those questions. And a lot of times if we don't see the right answers, then yeah, it becomes a deal breaker for us. Because to us, if you haven't done that homework today, it's going to be a tough conversation tomorrow.
Good points. Very good points. Going on to, you know, common traits of, you know, good businesses on the valuation perspective. What are things that sellers should look for to get their business, you know, at that premium level from a valuation perspective?
Like prepared for evaluation or for a high valuation?
But well, less about the prepared since we talked about, more so from like to get the premium valuation.
Get the premium. The intangibles that you don't really see need to be there, right? That strong brand name, customer loyalty, customer diversification, the brand that your customers have as well is also beneficial, right? Big retailers, big wholesalers, those types of companies will help make your revenue a little bit more credible, right? It's likely to be recurring with, you know, a large enterprise client than it is with a small business. So that's definitely one thing. Strong financial governance as well will lead to a higher valuation just because it's going to be an easier process to go through. There's going to be less risk. You might have less earnout into the valuation or into the price that's actually paid if the financials can be trusted. But at the end of the day, the larger the track record of success, the larger the track record of profitability, that's going to increase your goodwill every single year, and you know that's going to be baked into the purchase price as well. So the longer you can prove that you're a profitable, cash flow positive business, the higher the valuation is going to be. That's all else equal, obviously.
Oh, that's great. And kind of tying on to that from a banking perspective, Arun, other key aspects you look from a lending rate for a potential, call it purchaser, or even on the sell side, what are key positive traits that you look for, not focus on the negative, but the positive things you look for that are going to have a better ability to get the proper funding for, let's say, a transaction?
You're looking from a seller standpoint or from a buyer standpoint?
Both.
I mean, it's going to be, obviously, primary is going to be financial wherewithal. You know, have you done the right due diligence? What have you been looking for? Right. We're asking the same questions. A lot of times we want to make sure, you know, if there's a stumbling block, do you have the resources financially, operationally? What's your backup plan? You know, if it's I mean, there's a couple of different ways you could look at a transaction, but let's just say it's strategic. Are we relying on the existing operation to support the acquisition? If so, then we want to look at how that company's run as well.
Good point. Jumping into, more looking at navigating lease agreements from a real estate perspective, what advice would you give to any sellers that looking at potentially selling a business that their leases might not be long-term leases? How would you navigate around that from an advising standpoint? Should they renew the lease? Should they, continue on or look for something different when they're getting ready to sell, let's say, the business where you're looking from the lease perspective standpoint?
Yeah, no, that's a great point. Actually, just went through that with a client last year. They had at least they were going through a business sale process. They had a lease that was probably 1/3 of market, and they didn't have the window of opportunity to renew wasn't there yet. The landlord wasn't gonna allow them opportunity, so it can be a real challenge. What you can do, I think you really have to mark where you are to market, identify the risk of your buyer's going to be educated. If any business Pete's selling, it's going to be big enough. So I think you have to do an assessment of either set the discount in place and get your extension done if you can, and peg it. Otherwise, your acquirer, the business is going to pick that number for you and pick what that delta is, and that's going to come off your EBITDA. So there's a bit of a thread there of how do you do it. But I think it's just assessing where the buyer of the business is looking at increase in rates in that, because we've seen lease rates go up 20-30% a year. It's been hard to peg them. And a lot of landlords just, quite frankly, won't let you. I think, in the last 3 to 4 months, I think that window of opportunity is opening up. So what was a quarter ago? I don't think that's going forward. But I would say the last 2 years, there's been very little opportunity to renegotiate. If you have 2 years left, your buyer's going to have to go into the future blind, and they're going to pick that. I think just, since the summer onwards, I think there's going to be more of an opportunity to renew leases early, peg the rates, set a stable platform for the business. So don't think what was 90 days ago is what it is now and what it'll be in Q1 of 2024.
Right. No, great points. And as we're rounding out a little bit of time here, so we're running out of a little bit of time, but I'm going to just look at maybe each of the panelists here, give us what your outlook is for 2024 for the next, call it 12 months. So maybe start with Mike and then Arun and then Stewart. And again, no crystal balls here. So
yeah, well, no crystal balls for sure, but for the sake of my personal mortgage renewal, as well as the businesses that we work with, hoping for a couple of interest rate declines. Not looking for that in January, February, March, but at some point in 2024, hoping for that. Again, I just want to reiterate, the stronger the business, the more resilient the valuation. So just if you can really shore up the quality of your business, quality of the customer relationships, the financial governance that I was talking about earlier, that'll really help out. But yeah, hoping for a little bit more of a recovery in the second half of 2024, led by interest rate declines, inflation down. You mentioned it's 3.1 in Canada. Hopefully that breaks the 3 mark earlier rather than later. And then the economic environment just overall improves. That's not what I'm saying will happen, but I'm very much hoping that does.
Well, I mean, so what I'm going to say next is basically my opinion as a professional versus, an official statement from the bank. It's comforting to see inflation come down. I think just from what I see and what I hear, in all my discussions, I think the next probably 12 months is still going to be a little bit of a challenge. I think we've got to weather the storm more than anything else. Will we get out of it? Yes. What that will look like, it's tough to say, because I think the world over, if you roll back the clock even 5-7 years ago, was primarily driven by economics. I think it's a little bit more geopolitical right now. So, both from a predictability and more from an advice standpoint is, if you've got some resources, hang on to them. It's going to involve a lot more planning, I think, more than anything else, because it's tough to accurately predict anymore. And I say this even as a lender, when we look at projections, it's great, but honestly, how much can you predict, right? So it's planning, watch your resources, look at your efficiencies, because that's going to be the name of the game, I think, for the next 12 to 18.
Very good points. And Stewart.
Yeah, on the real estate side, I mean, we've seen the vacancy rate go up. It's more than doubled in the last 6-9 months. I think we're going to continue to see it flutter up. Our absorption is slightly off, not in a dramatic way, but slightly off. Our new construction's hitting a new peak, but I think that will be, absorbed in 2024 and the first part of 2025 based on absorption numbers. So I think you're going to see vacancy tick up. I think you're going to see lease rates settle off. And I'm always the opportunist, looking where are the opportunities, where you can find arbitrage in it. And there's opportunity for businesses in this room, particularly in the warehousing side. There are companies that have signed leases 4 or 5 years ago before all that escalation that are coming to market with subleases. So, is there an opportunity to take a 25% discount to market and capture one of those subleases with 5, 6, 7 years left on it? So, whereas the market might come off, 5, 7%. I think there are arbitrage opportunities to go in and really, capture contracts, capture value. And I think our new construction in 2025 will probably taper off. We've got a big backload for Toronto standards. It doesn't compare to Texas or Atlanta or any of those markets. We're very conservative, but I think we'll go more towards a design build market as opposed to a speculative market. But Toronto's, on the positive side, the immigration policy is here. We're bringing in big numbers. It's going to require more warehouses. It's going to absorb more land. So I think that'll be a good balancing factor for us.
Yeah, good point. And just to end it off, that what we see from an outlook, and I mentioned a little bit earlier, is with the excess supply of the transportation businesses eventually, unfortunately, but needed getting out of the market. So people obviously closing, new entrants to the market that, again, didn't have proper financial or corporate governance. Those companies are going to be removing themselves from the market by their own, self, if you will. That we'll be seeing happening Q1, Q2 of this coming year. And it's already been happening for the last 6 months. We see a lot of things that aren't reported, obviously, in the media or anything else. And we've seen a lot of companies that have gone out of business over the last 6 months. Again, not properly set up businesses that came in on the fly during COVID and then have exited the market. So it's actually, that excess is removing the market now and will continue to remove themselves from the market in the last, call it Q1, Q2. And then the inventory I talked about, that the shippers had an excess number of inventory that they're working through currently, and Q1 should be the majority out of that. So then the shippers are going to need, again, more inventory. The manufacturers are going to have to produce. And again, as interest rates slowly come down, people are going to have a positive sentiment of the economy, looking to buy more items and looking to get involved in more spaces too as well. So I think that's, from a positive outlook, again, late Q2 into the new year, we're seeing quite positive trends. So again, it'll be, same volatility for the next, call it 3, 4, 5 months, but beyond that, let's call it, from the winter standpoint. So we'll see stuff out of the winter being, I think, a lot more positive from, the M&A standpoint, from the key economic indicators in the supply chain that we see, from, again, volume, rates, et cetera. So it looks, again, from our perspective, compared to where it has been, it's looking actually quite positive. So we're pretty excited about the midterm future looking ahead. On that note, we'll see if, just to tie things off, since we're at 1 o'clock now, I'd like to see if there's anybody has any questions from the audience, and then we could see about 1 or 2 from the online audience as well too. So anybody in the audience? For any of us, it doesn't, everybody here.
Thanks everyone for the great insights from our panelists and from Peter. Anyone here, we'd like to open it up to the floor. And if you'd like to ask a question, please just raise your hand and I'll walk over with the mic and you can ask it. We do also have a few questions from 2 questions that we've received from our online registrants watching on Zoom right now. So can kick those off too if no one has any questions here.
Sure, let's maybe do that.
Cool. Perfect. So our first question is that's been submitted is, how do you determine the normalized EBITDA multiple that a supply chain business sells for, and what factors play into this?
Okay, I could start off with that one and see if anybody else wants to jump in. There's a number of factors that people look at. So customer concentration, supplier concentration, industry concentration, key person risk, geographic concentration. So anything we look at, there's going to be a multiple range that we give our clients. So it's, for example purposes, 4 to 6 times, let's say. if you have high customer concentration, you have, high supplier concentration, key person risk, so one person is doing everything, you're going to be on the lower end of the valuation of that range. But if you have low customer concentration, low supplier risk, low key person risk, and other service offerings, then that's going to be on the higher end of that valuation. Now, something to note on that from, call it a business perspective, key customer concentration isn't a terrible thing if it's not sticky, then that's obviously scary. But if it's sticky from a warehousing perspective, from a value add perspective, doing pick and pack, co-pack, fulfillment, plus you're doing the asset-based moves, plus you're doing the brokerage on that, it's very sticky. So there might be customer concentration, but if it's tied to different service lines in that business, then it's going to hold a lot more value than just doing one piece in the business. So I would say those are the pieces that, for the person online looking, that those are the key things to look at from a standpoint there.
Awesome. Thank you. And so for the second question I want to ask is what's an average earnout structure a seller could expect in a supply chain M&A deal?
Okay, that's me again. Again, it's going to use a room comment. It depends, right? It really depends on the type of business, the type of client, the longevity of the client, or longevity of the seller. Earnouts are a thing that are part of our industry just from an M&A perspective. But, before, as we talked about, where the earnouts were a lot less, let's say people getting, 80, 90% or 100% cash on close. Those don't exist in today's environment with the volatility. So you're looking at an earnout structure that's probably anywhere from, call it 60 to, 80, low 80% cash on close, with the rest being either a VTB or vendor take back or an earnout. And usually the earnouts are structured from a standpoint of, maintaining your EBITDA, right? So effectively maintaining your net profit. And what we're commonly seeing right now is if you don't get to that point, usually there's a buffer in between, but at the very bottom, there might be, let's say your EBITDA is $5 million. If you get below 4, then your earnout will be 0. So we're seeing a lot of people from a protective mechanism to make sure that they're buying a business at that value. But if it gets below a certain value, then you get nothing. And what a buyer is looking at, they're saying, look, we're buying at X, so we should get X, or at least close to X. We'll give you some room. But if you get below a certain threshold, we can't justify paying at X amount. So it's something we're seeing. But usually earnouts, they're called, before COVID used to be 2 years we would see, but now they're anywhere from 1 to 2. Generally 1 is what we commonly see from an earnout length of time. But yeah, you're looking at, call it 1-year earnouts, typically anywhere from 60 to 80% cash on close. Hopefully that answers it. Oh,
Thanks, Peter.
Got a question in the back.
Hello, everyone. Thank you, Peter. And thank you for all the panelists, by the way, for today's discussion. My question is, so you said something that's really interesting, which is less private equity and venture capitals are now in, and it's more business owners that are buying the companies, which it makes more due diligence, but it also, at the same time, it adds a lot of emotions. You're talking about person to person now, rather than it's an organization to organization. What's your recommendation to manage these emotions, to make sure that the ego side or the emotion side is not in the way, that eventually a good deal can just simply move away because my emotions is there? You're talking really bad about my company or this thing that I have been growing for a while. So what's your experience on this? Thank you.
No, good question. I would say this is, more than anything, I think that working with the proper investment banker, I mean, we're specialized only in transportation logistics and supply chain. So I think it's important to work with somebody that knows the space you're in. Obviously, we're in this space, so I'd always recommend us. But, from the standpoint is level setting expectations, because the biggest thing you could do to a client is give them the reality of the situation. Don't give them hypotheticals. We see often that other people that are investment bankers, if we're representing a buyer and we're trying to buy a business and somebody else is representing the seller, but that seller's advisor, investment banker isn't from the space, they're giving them inaccurate information. They're not having a good picture of this industry from a structure standpoint, from an enterprise value standpoint, from a multiple standpoint. I mean, we see people come across of little companies that are saying we want 10 times EBITDA. That's crazy. You're not getting that. So the reality is working with somebody that knows the space to level set those expectations. Because if you could level set those expectations initially, so even before a contract is signed, then at least that emotionality is more consistent as opposed to being up and down, right? The difference where somebody might get frustrated is if there's different information giving to them. So it's best to give them the correct information right off the bat. So at least it's consistent. So the emotionality at least is a little bit more contained, but there's always going to be emotion in M&A. Doesn't matter. It's from all sides. For most of people here and other people online, they've only built one business. 91% of Canadian entrepreneurs are single business owners that have created one business, not multiple businesses, one. So it's their baby and you have to respect it, especially if you're on the other side, respect it. But at the same token, you got to be cognizant of the reality that everyone's in the same situation and you have to be able to speak the truth as opposed to stuff, call it, M&A online where you could Google things and see something sold for 20x. Without having context behind it, it's really difficult, right? So it's good having a level sets or an advisor, explain to them what the correct, value of their business is and what to expect. So having somebody lead you down that path that understands the space, I think is vital.
Thank you.
Hi, everyone. Aaron Vole, CEO at Onward. I've got a question for you with regards to M&A and how price ties in with terms. Obviously, they're intertwined. If terms are better, maybe you have a lower price. If price is better, maybe you have worse terms. Can you speak to that ratio a little bit more? So as an example, you've got a company that's 70% cash, 30% earnout, like you mentioned. If you were to go down to 60% cash, 40% earnout, how would that affect price? Is there a ratio that you can speak to that might give indication of how that ties together?
The tough thing is, again, it's going to be, the same.
Thank you.
Same thing I mentioned. It depends, right? So if there's always going to be room to play with from an M&A, call it negotiating standpoint on, the levers you could pull. So you might be able to increase the enterprise value if the cash on close comes down. It all depends on the type of transaction and the type of, volatility that potential seller is seeing too. So there's no actual real ratio, but if let's say it comes down from 70% cash on close to 60% and it was 5 times, you might be able to push to get 5.25 because you're de-risking the position from a cash on close perspective, right? I think most buyers are, especially in today's environment, looking at historicals from 2021, 2022, their answer to everything that, most sellers, obviously they're, talked about emotion, say they could, we're great, we're the best company we've ever seen, we could hit all the numbers. Then a buyer comes back and says, prove it. And the great way of proving it is by saying, great, then prove it from an earnout perspective, have more of an earnout, right? So if somebody is coming at, talking to anybody and saying we could do it, the buyer is going to equally come back saying, great, we agree with you. You're telling us you could do it. So let's add that into the purchase price. Because from a buyer's perspective, they're going to look at that saying, hey, if you reach a higher number, it benefits them as well. So ultimately, if you're able to come down on cash on close and increase the enterprise value, that is definitely something that can happen. But the terms will fluctuate based on the nuances of each deal, unfortunately. So there's no real ratio, I'd love to say, because every transaction is different size, different vertical, different concentration profiles, everything. So a good question. Thank you.
Thanks, Peter. Just want to ask if anyone else has any questions. Happy to bring the mic over.
That's great. Look, with that in mind, again, appreciate everybody for being here today and taking the time to enjoy some lunch and have good conversations and spend time with our panelists here. I'd love to thank our panelists. They're Mike, Arun, and Stewart for coming up here and joining me and joining us all here. So thank everybody. Give a round of applause for panelists. And again, thank you. We'll be hanging around here too. If you guys want to talk about M&A, want to talk about valuations, banking, real estate, we're going to hang around for the next bit. So by all means, come up to us, see us. And again, thank you guys for joining in and we appreciate everyone coming here. So thank you guys. Thank you.